Good morning. For Traders Exclusive, this is George Kachuk with RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. Well, the equities have been under pressure, but we're expecting a bounce this morning. That's pretty much what we're getting. So let's take a look at the equity markets. Pretty much they've been selling off over the last 2 weeks. Not really that hard, but there has been some selling pressure. And specifically last week, what we saw is the S&P closed below its 50-day moving average. The 50-day moving average is a place of institutional support, and it kind of broke down through it. Not in a decisive manner, but it is below it. We see the same thing in a NASDAQ composite, first time also trading below its 50-day moving average. So again, not a crash through it, but trading below it. We see the Dow also trading below its 50-day moving average. We have the small caps are just moving sideways. They've been doing that for a number of months, and same with the all-important transportation index. Now, why do we expect a bounce? Well, for one, some of the positives are we see the NASDAQ 100 still trading above its 50-day moving average, and that in that index, that's pretty much your big cap stocks like your Apples, your Facebooks, and those are all doing pretty well. Your Amazon still near their highs. That tells you that there's still a bid underneath this market. Now, again, on the downside, what we saw over the last few weeks is that your defensive groups are doing best, basically staples, utilities. That's not the kind of thing we want to see. You know, bit of a breakdown in technology stocks, financial stocks, consumer discretionary. So we'd like to see those groups turn up. So what about this bounce? Well, I'm expecting a bounce. Well, what we also saw was some extreme fear indexes hitting the market. Specifically, we look at the equity only put to call ratio. That spiked to 0.96. That's the highest we've seen in a long time, and that's usually coincides near market bottoms. We've only seen that happen about a dozen times over the last few years. Similarly, the TRIN, also known as the ARM index, it's a breadth indicator, also takes volume into consideration, spiked to 2 last Thursday. And that's, again, the kind of thing you see near market bottoms, especially after the market's been selling off for a while. And pretty much the market bottoms a few days around when we see these kind of spikes. We talked last week about the sentiment, pretty much bearish, and we're only 3% off the highs. So that kind of tells you that there is some selling pressure in the market. However, there seems to be a bid underneath this market, and that's what I've been looking for. However, please keep in mind that, yes, the S&P still can trade down to the 2,300 level. That may be an area that it still wants to test, and even if we get a little bounce through, we might see it sell off there. So kind of you have to allocate accordingly. Now, as far as strength we talked about, we still see it in the big cap stocks, your mega caps like, you know, the Facebooks, Apples, the Netflix, the Teslas of the world. We have a lot of earnings coming out this week. We'll see how that impacts these stocks. Also, we see strength in home building stocks. So if you want to look for some ideas, you might want to consult your financial advisor, see if any of those places suit your needs. But as always, these things are just indicators, so always let price and volume be your guide. This is George Kachuk with RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. Have a great trading week.